This week on URSEAT, I'm going to interview one of my dear friends, portfolio companies, and one of my favorite software as a service B2B companies. All together, they provide an incredible service to the investing and startup community, and they're one of my oldest investments. So we'll dive into kind of what his journey has been and into the product, and give you guys insight into what it looks like as you go from seed all the way into that growth place where you're ready to start taking on more customers and you've built out a full product suite. I hope you enjoy. Okay. Hi, Dustin. I'm so excited to talk to you today. Why don't you tell me a little bit about yourself and the company that you've been building?
Sure. Thanks for having me, Tiana. We've known each other for quite some time, actually. And for us, our relationship started in Austin, Texas, where I was a fintech entrepreneur. And but before getting into building financial technology startups, I was working at Goldman Sachs in the middle of the financial collapse. And so I was at Goldman I went to undergrad at Columbia, played football there, and then kind of did just what everybody else does at Columbia, just got my diploma and walked out one door, walked into another, into the Goldman lobby, and just didn't really know you could do much else, actually. And that's sure what everybody did. But that ended up being a really good place for me as a future fintech entrepreneur to be able to download a lot of systemic problems that the financial services industry has and continues to have. And I initially focused a lot of my efforts on crypto. And that's sort of where our efforts, where our paths kind of crossed back when you were with Factum in the early days of the Wild West of cryptocurrency. And so that was 2013, 2014. I was working then. A little soon thereafter, started working on the first viable proof of stake algorithm called Tendermint. Tendermint's pretty interesting because before Ethereum switched to proof of stake, it was the most widely used proof of stake algorithm in the world, securing more than $100 billion of assets. And now it's the second most widely used proof of stake algorithm. Secures a lot of notable blockchains in the Cosmos ecosystem, as well as other standalone blockchains like Binance, or previously it secured Luna. And so I've always been very interested in platform foundational technologies. In my mind, that's sort of where I get excited. I do some angel investing, but when I'm thinking about investing my time is my most valuable, scarce resource. And so when I'm looking at kind of investments of time, I'm very choosy, very picky about where I'm putting my time, my effort. And so I'm always kind of looking for the biggest bang for my buck. And so I'm always kind of like, my brain's just like kind of tuned into a lot of these. Whenever I see like major platform technologies, I get really, really excited. Super big problem, hairy problems to solve. Another one I worked on in the crypto space was cross-chain technology. Some of the first generation bridges. I was president of a company called WAN Chain. Some people might remember the Interoperability Alliance. It was like a whole thing in 2017 as this pain point around moving value between blockchains became very obvious. And we were one of the early leaders in that. And from there, spun out of WAN Chain to actually start to build applications and services on top of the WAN Chain blockchain, but with a focus on founders. And my co-founder Rajesh Gopi and we actually spun out of WAN Chain together to go do this. And in the process, that path of like initially focusing on like security tokens and different things and different tooling for founders led us to thinking about liquidity for founders, traditional founders, as opposed to just for the crypto folks. And from there, thinking about liquidity and thinking about traditional equity, we spotted what we believe is the mother of all categories in equity management, and we became a cap table company. We kind of put the liquidity stuff on the side, on the shelf for a later date. We pulled out all the blockchain and security token stuff because at the time, still to my opinion is the case that the market is not ready for those solutions at scale. When you're talking about securities, there's a lot of regulation and cost involved. And so we kind of put a lot of the digital asset stuff on the shelf, became just a pure fintech SaaS company. And that's when we really started getting a lot of traction. That's when we're focusing on cap tables. And so happy to get into our solution. But we see equity management as this kind of foundational layer that Web 2 forgot to build. We kind of tried to jump the gun a little bit to Web 3. We said, well, we can't skip over Web 2. So we do have some aspirations of getting into crypto and blockchain, things like that with 212 in the future, potentially distant future. But right now, we're really just focusing on solving some of the foundational equity management issues that are in the startup ecosystem.
Nice. When you were at Goldman, what was sort of like your moment when you realized that maybe you didn't want to just be a company man, that you wanted to build your own company? Like, a lot of people would be like, working at Goldman or one other the big banks, UBS or something like that, and that's your career, and you climb that ladder. What made you jump off that ladder and move away from that and into entrepreneurship?
I could tell you the day. It was
Everyone has their moment.
we recently moved over from 85 Broad, was the old Goldman Global headquarters, and moved a few blocks away to 200 West Street, one of the most expensive, nicest buildings in New York. The lobby is like the size of a football field. It just takes 10 minutes just to swipe your card and get to the elevator. But before swiping your card one morning, I'm walking into office at the new headquarters, and again, being in the middle of financial collapse, this is when the 1% protests are going down, everything. And people are just like arm in arm around the building, like blocking me from getting into work. And so I'm having to excuse me, I got to get into work here, and like break through this like people that are like barricading our office because they hate us so much. So that was kind of my, okay, maybe this is not the thing that I want my life's work to be about. I had a position at Goldman that I was exposed to a lot of the, I was exposed to a lot of that public frustration with Goldman for my role, and so we're kind of having a firsthand look at it, made me realize that that maybe the change I want to make is best made from the outside. And so there's also that there's kind of like the moral issue, but about where you want to spend your time. Do you want to spend your time building value for yourself, building value for founders and a community you care a lot about, or do you want to spend your time lining somebody's pockets or helping them buy jet fuel, whatever they need to get around? So I do still have a lot of respect for the people that work at Goldman Sachs. I thought that their caliber is very, very high. I actually always thought it was higher than Ivy League. If I had to pick, okay, this person worked at Goldman or this person worked at Ivy League school, I'd say, go with the Goldman person. They're usually very good at sorting and filtering people. But it comes down to just, where do I want to invest my time, and how do I want to make the world spin faster? And it's definitely not in, a big bulge bracket bank. Taking some of the insights I learned from finance and passion for startups just allowed me to just dive into the startup ecosystem and building our own software and making our own way.
Nice. Why Austin?
It was cheaper than San Francisco. So this is 10 years ago.
I don't know now.
Yeah.
It might not be now.
Yeah. I was going to University of Michigan, and that's where I met my wife. I was getting my MBA there. So left Goldman to career switch. And one of the nice things about career switching is that, when you go get your MBA, you can kind of like, build your first startups with the, Uncle Sam's investment and backing. And so, I moved to Austin, to Ann Arbor, got my spend down to like $800 a month, and was able to be super lean and got some student loans and started my first business. And then from there, 2 years later, my wife and I were looking for a tech city that was warm, and I visited Austin for South by Southwest and a bachelor party, and totally fell in love with it. And never had just deep kinship with the city. It just felt like the right place for me and for my family. And I never kind of felt that way with San Francisco. I would visit, and I just never kind of felt like this is my spot. And Austin, I just felt like that immediately. And the quality of life was just insane, especially in the early days of getting my career going. That's I think a really challenging thing is like getting through that early hump as a founder, when you're really learning and figuring it out and building your network. So like keeping your personal burn low is pretty important.
Yeah, that makes sense. Okay. So let's get into a little bit of what you guys been doing with 212. And if you're ready, we can do the deck. If not, I had maybe one more question for you. Because I was an early supporter of 212. I've always thought that you were a rock star entrepreneur. And so I wasn't as attached to what you were doing with 212. Like I knew that you would just figure it out, and that's sort of like part of the journey. But can you talk to me a little bit about that piece for you around, you know, how and when you decided to pivot? Because I remember when we first met to talk about investment. We were in New York. We were going to a conference, and you told me about it, and I was like, I don't care what you're doing. Here's just take my money. But since then it's changed because we were first looking at that liquidity and like
Mhm.
an ATS or something like that for
Mhm.
trading. Can you tell me about how you guys knew to make that switch and that piece?
Yeah, there's been a few different pivots, like any good any good startup journey. Most of our pivots, I'd broadly categorize them as being more and more focused around scale. And so it's like, some of these really hairy regulatory problems are very challenging to scale. And so if you're trying to create liquidity for founders and startup ecosystem, you need a lot of capital to be able to, one, to be able to just get through the regulatory malaise. And then two, even operating these businesses can be very expensive because of the operational overhaul. So we just started thinking about, how do we build like really massive, really huge businesses, and they're like probably not don't have a ton of regulation around them. And then just thinking more about the foundational problem at hand here. The secondary liquidity is an important problem to solve, but we needed to settle all those transactions somewhere. And so we're not going to take a couple steps forward and provide this like next generation secondary liquidity solution and then settle everything into a spreadsheet. And we knew, and so the more we started thinking about this, say, hey, why aren't there any API enabled cap table management solutions? We realized that like building one would also not only solve our problem, but also solve all sorts of other problems. And then we started thinking more about the building this Web 2 layer, equity layer that hasn't yet been built, kind of like the Plaid for equity. And we just thought it would scale tremendously well. There's all these embedded network effects into it, and in the process, you can create a ton of value for founders, and that really gets us excited. We do monetize. A lot of our monetizing is on the backs of investors. We have a lot of great products and services for investors, and love supporting them. But what really I kind of say it this way: um, investors pay me to get out of bed in the morning. I just get out of bed by my own to go help founders out. So it's so I think like getting more passionate about the startup ecosystem and just thinking through sequencing of being a multi-product and kind of like a suite of products and services. How do you sequence launching all these? It's just more and more obvious that like at the heart of this whole ecosystem is an API enabled, affordable, transparently priced, fully featured cap table. And then that is really the thing that acts as a source of truth that powers this whole ecosystem. And so we had some great advisors along the way, like yourself, and we had some folks in the Mass Challenge accelerator that helped us, kind of think through this as well. But the biggest pivot was just completely putting the secondary, going from being a secondary liquidity company that also had a cap table to like secondary liquidity is going on the shelf. We're going to get back to that later. We're a cap table company. That was the biggest pivot. And since then, we haven't really looked back. That was the last main pivot we had. And since then, it's just been adding to the suite and developing the products and so forth.
Okay. I want to get into the pitch and um, also acknowledge like there's a lot of cap table solutions. So where are you guys fitting in the market and how are you thinking about the competitive landscape? But let's go
Sure.
ahead and
That's like
roll
right,
into the pitch.
that's right in the pitch. So we can,
Okay.
let me get my, give me 1 second. Well, thanks for having me here, Tiana. 212, you can best think about us as a company that's building the digital rails that the startup asset class deserves. Um, it's kind of like the plaid for equity. And why, why do we need the plaid for equity? Why do we need this kind of like programmatic approach to equity management? And the problem really stems from a surprise. Competing cap table management solutions are actually largely services driven businesses. And here you can see when you type in Carta Fund Administration, they say service and technology combined. Under the hood, these providers are best described as web UIs on top of spreadsheets that are updated manually by humans. And human products are, they're slow, they're expensive, and they make really critical mistakes at times. And importantly, they're also siloed and unconnected, which prevents sharing real-time information and kind of plays back into this like digital rails comment I mentioned before. And the Web 2 basically forgot to build this equity layer. And so things feel digital because you get to this login, and but under the hood, they're really more manual than you might think. Even with Carta, when they have like, you have a fund admin and a Carta cap table, the cap table updates, like the fund doesn't update in real time. There's no information sharing directly between these two pipes, let alone if someone's on like LTSC and someone's on Carta and so forth. So, and even worse than any of this, any of the competitors are spreadsheets, which is actually the vast majority of the ecosystem. Probably 95% of all cap tables are on spreadsheets. So our approach is 100% API and programmatic. And so this approach is fundamentally different than the competition. And with our model, the 212 acts as the source of truth. The cap table powers a whole suite of equity management solutions, fund administration, SPVs, valuation products. It all is powered in real time via the cap table as this atomic unit of truth within the ecosystem. With 212, our equity, we also have an equity math engine, which is very, very powerful and very different than the competitors. We can effectively solve for a lot of human error, which is common when different securities are stacked on one another. Because our equity math engine, my co-founder has found us saying, hey, if you can put it into a spreadsheet, I can program it. And so it's just been a lot of trial and error. We've been at this for 4 years, dealing a lot of the long tail use cases. The weird, our product is very fully featured, fully battle tested, handle down rounds, how to handle late stage companies with massive amounts of complexity. But you can kind of, the best way to kind of see us within the ecosystem is very, product driven. It's real time, scalable, accurate, and affordable. It's $240 a year flat. And so the idea is we use this as the loss leader, as the wedge to get in to sell our higher price point products and services. Even though we're only charging like $240, we still are anticipating about $2,000 revenue per founder. And then it also makes like the fund admin, SPV solutions, and all these other things, also drives those and makes those more affordable. Because if you're a fund admin and you've got 50 investments, you don't have to force all your founders to pay $10,000 a year. You can just include this in the package. Where are we today? We've successfully served customers from pre-seed to Series C, 400 plus founders, 300 million plus in equity, and 10,000 investors. We started a company in May of 2018. Spent about a year working on some stuff in the security token space. We pivoted out of, so we've really been heads down on cap table for about 3 years. A lot of happy customers. Here's just one of them. I tried them all, and 212 is a sweet spot for features and price. Michael Francis, founder and CEO of NanoShield. The mission. So now that we've created this API and programmatic cap table, we can use it to drive a real-time suite of equity management products. Imagine the possibility of digitizing the entire startup asset class. And so here you see cap table at the middle. You got SPV formation, fundraise administration, fundraise valuation, transfer agent. This cap table is driving all of these products and services. Recently, we launched our venture capital fund administration product. Value proposition here is automatic and real-time dashboarding and an instant audit-ready reports. You might be surprised to know that if you run a report on a competing fund admin solution, it usually takes 4 to 8 weeks. That's because they don't have the data in real time to be able to run the reports. And so they have to go collect the data from all the cap tables. Humans are processing the data in kind of the same way they've been doing for 50 years. And then, 8 weeks later, you get this like mission critical report you were biting your nails waiting for, something that we can just do immediately. Here's Dave Shields, CFO of Bolt. He was formerly the controller at Reed Hoffman's Greylock Capital. He's a customer of ours. He says, I love the real-time processing of their VC fund admin product. And here's a referral we received last week where the sending party says pretty clearly better than Carta. So the organic referrals are rolling in. And now we're starting to work on SPV formation. We recently acquired Latium SPV to speed up their time into this market. And we'll be rolling this product out in the coming weeks. A similar value proposition to the fund admin. Effectively, currently state of SPV is you go to Assure, somebody like that, you write them a check, you invest, and then everything is updated via spreadsheets, via email. Maybe you get an update once a year, once a quarter. If you're lucky on the value of that SPV, whereas with 212, that SPV is going to be tied to a cap table. And so that SPV instance is updated constantly in real time. Jose Padilla, we acquired his firm Latium SPV, and he says their API-enabled cap table allows greater efficiency and transparency. So, and you're kind of thinking about our go-to-market, we have one track that's focused specifically on these syndicate sales. And excuse me, we've been thinking a lot about where to focus our efforts. As a startup, we always have to think about where the biggest ROI on our time is. And syndicate sales to us look extraordinarily attractive because they're so non-served and high value. And it gets compounded when you're doing like dozens of SPVs a month. Just talking to these customers, their hair is pretty much on fire. So much so that we're getting a lot of market pull with syndicates even before launching the SPV product. And these large syndicates have the ability to generate about $1 million a year in revenue. So we start with this $240 cap table. People are like, oh, how big a business could that be? But the suite of equity management products is really where a lot of the upside is. So here's an example of like one syndicate. I'm using numbers here, 15 cap tables a month and about 6K per SPV. And that's, over $1 million in revenue. It's a high margin revenue as well. And there's quite a few of these different syndicates and angel networks. Here's one of them, Ham from Draper Decentralized, who says we're exploring the opportunity of using 212's API in order to create SPVs for Draper X. Unique advantage is that the investors will be able to see real-time the value of their investments. Our leadership team has experience building platform technology, API solutions, and scaling startups. I started my career at Goldman during the financial collapse, then co-founded Tendermint, which is the second most widely used proof of stake algorithm in the world, and secures more than 100 billion of assets. My co-founder Rajesh built API-enabled technology for 3-letter agencies, and Young has a proven playbook for scale revenue and human capital. This was us hanging out in San Diego. So there's kind of two main threads we're pulling on our go-to-market. One is the enterprise sales, going after syndicates, and the other is a very programmatic approach. We're talking, online, a digital footprint, SEO, paid ads, much more kind of like coin-operated approach that you can really depend on. Where these enterprise sales are like these big clients, but it's kind of choppy in terms of like, when these folks will close, how long it takes you to get them up and running. And so we think having both will really kind of make us very resilient and young. And it's kind of like the programmatic is also mostly focused on founders. And so we get kind of like our unit economics, we get the cap table numbers up, build the network value, and then also go for revenue with the enterprise sales. And Young has a really proven playbook here with building, he's taken multiple companies from Series C to Series C in fast order. It has a lot, the initial focus is on building a digital footprint. So if you look at our social media now, you'll see a lot more activity than previously, and then starting to build the demand. So then doing a lot of paid ads and demand funnels and things like that. And you want the digital footprint first, so when people are evaluating you, then they can part of the evaluation is just pulling up your social media profile, and also, of course, like the long value of SEO and all the other things take time to materialize. And then obviously we're doing PR and other events. So we're big sponsors of a lot of stuff in San Diego, in Austin, and also moving to San Antonio, Dallas, Houston. We're really working on kind of saturating the local Texas market. We think we could be a $1 billion company just servicing the back end of equity management for Texas alone. But Texas is not where our aspirations start or stop. We kind of mentioned that one of the big problems we want to solve is around secondary liquidity. Eventually, also the data that we're collecting from all these cap tables is extraordinarily valuable. Having responsible business models that allow founders to push data, gives founders reasons to push their data for them to be found, kind of building like a real-time competitor pitch book. We actually already have built real-time cap table search. We're just waiting on the network effects to kind of materialize to turn that on and productize and market that. But along with that are kind of like these real-time macro insights that we can pull around, different themes that are emerging in the startup asset class. There's a lot of fun stuff going on, but most fun of all is making founders creating value for founders, and at a $240 cap table when people switch over and they're paying $5, $10, $20, $50,000 for a solution that does less. They get really excited. So that gets me out of bed in the morning, and happy to answer questions you have.
Nice. Very good. Okay.
So it seems like you guys have started to figure out your product market fit and you're looking to scale up. Is that right?
Yep. So we have like our core leadership team in place now. We have Young's playbook is ready to go. That's about $50K a month to run his marketing playbook. And then Rajesh has some, we have a really strong technical team. I'm looking for, now as, fun job as CEO, now that I have good generals underneath me, my focus is increasingly more and more about recruiting the next, recruiting and fundraising. And so, we're ready for scale, and I'm working a lot on helping the organization do that with both recruiting and fundraising.
That's lovely. A lot of companies that are ready to scale typically just have one like minimal viable product that is just sort of working. What is distinct about 212 is that you guys have a suite of products. When you're going to go for, this round that you're doing, what are you going to focus primarily on for growth?
Cap table. So the programmatic sales with Young Han's engine, this is really where most of the where'd I go? This is really where most of the short-term effort is the concentrated effort is going. As we build out some more of our enterprise customer products. And we're going through our first batch of enterprise customer products, but we do those to get the customer discovery and to fine tune. And we won't be really scaling those products till probably for another 3 to 6 months.
Okay. So between the big gorillas in this space, like Carta, and Morgan Stanley just threw their hat in the ring, and then you have half a dozen free, or somebody just wants to use a spreadsheet. Where are you guys threading that needle? How are you distinguishing yourself from the Carta versus the Morgan Stanley? Because those are both those groups are highly capitalized. Where are you guys moving?
Well, from a branding perspective, I'm leaning a lot on unlimited, and unlimited cap table management is something that's not seen in the marketplace today. And so unlimited rounds, unlimited shareholders, unlimited dilution exit modeling, particularly on the dilution exit modeling, nobody does it as well as we do it. And for sure, nobody offers it. And the kind of like unlimited, create as many rounds and bridge financing and stock split and exit models as you want. And so that's an area where when people use our product, they're like, there's this huge wow factor, and they tell their friends about it. And so to date, we've actually had all of our revenue growth has just been from word of mouth. Like this programmatic sales is like we're really just putting our first effort into marketing and more of the traditional sense. And so, we've been extraordinarily product focused, and when people use our product, that becomes apparent to them when they, especially people that have used other products, and then they tell their friends. And so, I think good products that are easy to use and affordably priced usually end up doing pretty well. I think a lot of people think too hard about some of the stuff. Founders are very, very, very price sensitive, especially in this market. And so, offering them everything they need at a price they can afford. I mean, I close people in 5 minutes. I get them on the phone, and they're just basically calling me to check that I'm a real person. And they're on, and they're telling their friends. I mean, similarly, I think free people are skeptical of free products. How are you going to support this? Like, what is your business model? What's the catch? We can support for $240. We still have 85% margin because we built the proper product. And so I think I thought a lot about. We used to want to give away cap tables for free, and I think that's the wrong way to do it because people won't trust it. I think $20 a month, you see that kind of $20 a month pricing, a lot of different like TurboTax, QuickBooks, G Suite, it's like very common. And so I don't think we can be undercut effectively. I mean, we've got the market. I'm hoping this is the market clearing price, that like it's actually better to charge $240 than free, but the last thing you want to do is charge $10,000, $20,000 for this product that has like loaded with network effects and data and can drive all these other high price point products, but you're trying to claw $10,000. And we've had, I guess I'm going a little tangent. We had a crowdfunding company raise $80,000 and cart a quote and then 50.
Yeah, that's
crazy.
true. With Carta's business model, it's per person on your cap table. And so it can very easily start a baby startup is putting, $10,000 into a glorified spreadsheet when that might have served them better for marketing or, being able to have one more month of burn for their founder. So it's a big deal, especially I would say the place that I see you guys fitting really well is the move the industry has made towards SPVs and crowdfunding, given that both of those are a tremendous number of individuals could be investing, up to a couple hundred. And that's just not affordable at those lower price, like the lower amounts of capital raised. And I think Carta specifically, I don't know as much about the Morgan Stanley product yet, seems to be built by and for Silicon Valley raises, where you raise a tremendous amount of money, and then you just try to throw money at the wall as fast as possible to grow as fast as possible. So you're not thinking about sort of that lean startup and getting off the ground as much in that model. Okay. Have you guys done much looking into other sort of spaces, or is that sort of right that you guys are going to go after the CF space and the SPV space?
Yeah. There's a lot of things we're going to touch. Investor management is another one. We've got some beta products launching. It's really the Amazon of equity services. So it's like everything that touches equity, like we want to be in. And so, we're not the Casper mattress model. It's not a mono product company. It's a whole suite of products and services, and that suite will just continue to grow. We're a very creative team and very generative, and so a lot of my job as CEO is just like, okay, focus. Where we're gonna, okay, we got a lot of ideas, but let's do them mindfully and kind of stack them in the right order. But yeah, eventually getting into competing with PitchBook. Carta has Carta X, like that's where we started, was on secondary liquidity and put that on the shelf. And so we'll be getting back there as well. We've been thinking more and more about that recently. So, in general, like that Carta's valued $6.9 billion. I'm quite confident that the leader in equity management, the digitization of equity management, will be worth 10 billion or more. So we're the team that I believe can actually build a product and scale the category, because the category is still tiny. I mean, you probably have, let me slip through. I think this is like, you probably have 94% of the market still using spreadsheets. So, we really don't even go after Carta customers. Like they come to us because they're so frustrated. Most of our focus is around getting the whole ecosystem off of spreadsheets. The spreadsheets are just terrible. I mean, even though Carta and the others are expensive, like you really have like foundational risk if you're using a spreadsheet. And everybody thinks it's simple, and it's just not. It's the venture, like the terms and how these notes unwind and dilute, and very few founders really understand it. And so a lot of people think they do, and sometimes I'm often surprised at what my calculator puts out. I'll tell you that much. Like there's certain times when things come out when I'm put things in my dilution exit model. I'm like, wow, okay, that actually I'm diluting a lot more here than I expected. And so it's just, you got to get off spreadsheet. That's the first goal is like, and then once you get off spreadsheet, now that's where the digitization comes in. Okay, we got everybody off spreadsheet now. Like we get out their spreadsheet, basically like unconnected napkins that people are passing around. And so once we get everybody off of spreadsheet, then we can start getting more insights into what's actually going on in the startup ecosystem. We can make it a lot easier for people to be found. We can provide better resources, better tooling, make it easier, basically make it easier for founders to succeed and reduce the chance that they fail.
I had one more thought. So at like 240, I think the one feature when a founder comes to me and says, hey, like I need a cap table, I need a, actually often they're just coming to me trying to figure out how to raise money and what that looks like. And the thing I tell them is like, go do some round modeling so that you understand like, okay, if you raise at 8 million, it's this. And if you raise at 10 million, it's this. And if you raise using, a KISS, then it looks like this. And if you raise with a YC note with a 20% discount, it's going to look like this. And, the other piece that's really hard, it's like, not only as a founder trying to basically solve for like raising capital and serving that first customer, they also need to make sure that they own enough of their company in, the 7 years that they'll hopefully, on average be building their company out, that it's going to be worth it for them. And a lot of times they don't know. And they just get focused on, well, I'm going to take in this check, and they don't understand the consequences of taking in a check with the kind of terms that they have. So that's the thing that I repeatedly refer people to you guys for, is like, go do a round simulation before you raise, so that you understand the consequences. Because a lot of times they'll come to me and they're like, oh, I don't care, like I just need the capital now. And I'm like, well, it will all be for naught if you don't have it, if you're upside down, if you own less of this company than you expected. Because that can definitely happen and be, from my perspective, selfishly as an early stage investor, I really do not want my founders to feel upside down on their company, because you just sort of lose that momentum and drive, because you realize that none of it was worth it, and you can become quite resentful of all the blood, sweat, and tears that you put into a company to realize you don't own it.
Well, you're not only a good person in wanting that for the founders you invest in, but you're also pragmatic, because you know that if they don't, the later stage investors won't support them if they don't have enough skin in the game. If they don't have enough. I think the rule of thumb is like they want you to have like 60% ownership at Series A going into Series A or something like that. So that's kind of like, oh, if you had to give up like 20 in pre-seed and like 20 in seed. Frankly, I think that's a little high. I think you can do better than that if you're, if you're kind of smart. And you also have to figure in your options too there. So, I try to shoot for, 20, if you're giving up 20% around, to make sure you're getting a lot out of it, right? You're getting an investor that you really want. You're getting maybe some other value add. You really need the money. And your general rule of thumb, like don't do more than 40% if you can. And if you can get, 5 or 10%, even better. We were able, because we had this tool, we were able to kind of raise in like very small quantities over time. Just kind of, we did pre-money safes, just kind of ratcheted up the amount that we just kept increasing the cap slightly as we had more traction and we had more, our revenue was going up. But at the same time, like safes, you have to be careful, because safes have the down round protection. So this is you if you raise at a say you have a safe that has a 50 million pre-money cap, and then but you raise at 5 million. Well, 50 million doesn't matter. They're getting the $5 million price.
Right.
Now, so it's 100% downside protection. If you did that in a priced round, it's you call it a full ratchet, and it'd be like draconian terms. People would think that like you're crazy for asking for that. So if you have to be very careful with these safes, because you put in 50 million, you think you're going to get this 50 million valuation, but you have to run the model and say, like, if I priced around at 5 or 25 or 30, then what happens? And because that's when the terrible things happen, is when you priced around. And so you put in the cap, and then but you say, hey, well, what if this doesn't go to plan, and we can't raise, we have to raise it down round, especially in this market. How bad are we going to get or get hurt here? And so the answer a lot of times is to raise less capital if you have to do it, or actually pricing rounds earlier is actually can be beneficial. We're looking at pricing our round right now because we want to just get all these safes to convert, and then you don't have to use this tool as much, because like you just kind of know what everybody owns. It's a lot more straightforward. But as you're navigating that, and like you definitely need this tool. And the reason we price it, we include it, is it's a killer feature, but it's a birthright. We really feel like founders should have not only transparency of what they own today, but transparency of what they own in the future. And there's plenty of other ways for us to make money. So, we figured like, people need this. The ecosystems need this. Let's get this into as many hands as we can. And we're clever people that can build great products, and we can find other ways to make money with the suite of ecosystems. It's just the gift we give to the startup ecosystem.
And it's lovely that it's, you can just plug in and play with those numbers and do that before you go raise capital. I think that that's your killer application within this for early stage founders. Not only is it like a price that fits on a credit card and they can afford it, but it's also something that can help them really shape their decisions of like, do I go get another couple of customers so I can raise my valuation, or do I seek funding now? And that it takes the ambiguity out of that often confusing and sometimes scary process of raising capital. Well, I think we're about out of time, but thank you so much for taking the time to show me where you guys are at and what you're doing next. And I'm excited to see you guys keep growing.
Thanks so much, Tiana.
All right. Thanks,
Appreciate you
Dustin.
having me. Bye.
So guys, that was a B2B software as a service company right at the cusp of growth. I hope you enjoyed the interview and the pitch. If there's anything I can do to improve this series, please connect with me. If you're interested in being interviewed on my show, please connect. And also, if you are an inspiring investor and would like to look at becoming accredited so you can have access to deals like that, please hit me up. We'll be putting together a special course for accreditation. So an education piece so you know how to look at investments, and then accreditation so that you can access these kind of deals. I hope you enjoyed this, and I'll see you next week.